Berkshire cuts Apple investment by about 13%. Warren Buffett dumps 13% of Apple's stake right before their $110 billion buyback. Berkshire pairs huge Apple stake as both cash and operating profits set records. These headlines flooded mainstream outlets, from CNBC to Reuters, served hot right out of the oven as Berkshire held its AGM on the 4th of May. So when digging into the details, the value of Berkshire's stake in Apple actually fell 22% to $135 billion as of March 31st, compared to $174 billion at the end of 2023. So that's a change or delta of roughly $40 billion. Can we take a moment to appreciate how big this number is? It's roughly the entire market capitalization of Hershey, Yum Brands, or MSCI in one quarter. So based on changes in Apple's stock price, Berkshire appears to have sold about 115 million shares in one quarter, ending with around 790 million Apple shares today. So this move from Buffett actually raises eyebrows amongst the investing community as everyone starts to speculate and also guess the intentions behind this maneuver and this sale. So some actually speculate that Warren Buffett might think that Apple is currently overvalued given its circumstances. Others say that Apple's moat might not be as strong as previously given its recent slowdown in sales and also its complicated relationship with China. And some even talk about the potential concentration risk as it takes up too much of Berkshire's investment portfolio, while others said that Buffett is trying to beef up his war chest because the entire market seems to be overvalued and he might be waiting for an opportune time to strike again. So you know what else is worth striking? The like button, of course. So I think it's a once in a lifetime opportunity, so don't miss this out. Whatever it is, let's hear straight from the horse's mouth.
Last year, you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would. But we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that Charlie and I looked at common stocks or marketable equities or the things that people love to look at as being businesses. And so when we own a Dairy Queen or we own whatever it may be, we look at that as a business. And when we own Coca-Cola or American Express or Apple, we look at that as a business.
So the question was pointed and clear. He wants to know if Buffett has changed his mind on the moat and strength of Apple's business. So Buffett's response was actually quite interesting. Although he acknowledges Apple's moat, he went on to assert that he still expects Apple to be the largest holding of Berkshire's portfolio. To me, that's basically a non-answer, because Apple is already such a huge position and it will take Buffett a lot of effort to trim it down. So Buffett can still sell another $50 billion worth of Apple shares and it will still be the largest position in his entire portfolio, discounting the cash position, of course. So I'm not too sure why he actually made that comment. But in most investors' mind, I think it's an intuitive conclusion. If it's a good stock, you will buy it because you expect the price to go up. If you sold a stock, does it mean it's bad? So here's Buffett's response.
Unless something dramatically happens that really changes capital allocation, a strategy, we will have Apple as our largest investment, but I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive. And one thing that may surprise you, but almost everybody I know pays a lot more attention to not paying taxes than I think they should. We don't mind paying taxes at Berkshire, and we are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings. And they can change that percentage any year. And the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give. And I think that higher taxes are quite likely. And the government wants to take a greater share of your income or mine or Berkshire's, they can do it. And they may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it.
So from his response, he gave two main lines of reasoning. First, he don't mind building a larger cash position. Second, he floated the idea of a potential tax hike in the coming future, which could impact the earnings of all the companies that he owned. Clearly, Buffett doesn't need more cash for other purposes. He wants more cash. In this current interest rate regime, alternatives like treasury bills are offering more than 5% risk-free. And it gets harder to justify the risk-taking premium, unless there really is great opportunities out there in the market. That said, Berkshire, even before this Apple sale, is already sitting on a record cash pile. This time, after selling some Apple stocks, it just made another record number of nearly 189 billion US dollars. So I get that they want to build a fortress of a balance sheet, but it is also understandable why some investors are speculating that Buffett is foreseeing some turbulence in the near future and thus preparing his war chest. Who knows? Now, it's fun to speculate and come up with conjectures or hypotheses, but I think that it should stop there. Rather than spending most of your time thinking about what other people think, the time would be better spent when focusing on the underlying business, because you will never be able to know what Buffett is really thinking about, unless you are on his speed dial. As the saying goes, people sell a stock for 1,001 reasons, but they buy for only one. So when tracking the activity of Berkshire Hathaway over the last 18 months, the last time they added to their Apple position was back in Q1 of 2023, adding 20.4 million shares, and the price range for that quarter is between $130 to $165 per share. So take this information for whatever that it's worth. So when looking at Apple as a company today, the moat that they've essentially built over the years is easily identifiable. Brand monopoly, customer loyalty, high switching costs, barriers to entry, economies of scale. You name it, Apple has it all. So the two key problems that they currently face is their complicated relationship with China and their capital allocation strategy. Not only do they rely on China for their production capacity, they too also rely for their domestic demand. Currently, Apple makes up around 18% give or take of their total net sales from their recent quarterly report. And considering the state of current global affairs, Apple is really balancing on a very, very tight rope. So earlier this year, it was announced that the iPhone market share in China had slipped to 16% in 2024, falling to 4th place from a 2nd place in 2023 when it had a 19% market share. However, Tim Cook did address this concern in the latest earnings, saying that China iPhone sales actually grew quarter on quarter, and he's still very optimistic about China for the long term. So on the topic of capital allocation, Apple, unlike other big tech counterparts, did not have a sexy AI story to tell investors during their earnings. But instead, they told us to wait for the upcoming WWDC, which is the Worldwide Developer Conference, where they will unveil what they have up their sleeves. So the biggest gift to shareholders from the latest earnings, the largest share buyback program the world has ever seen. $110 billion worth of capital return. So share buyback may sound like a good thing at first, but it is really only beneficial if the company is able to buy back at a reasonable price, and preferably when the company is undervalued. So some investors are worried that Apple will lag behind this AI arms race, and they don't seem to treat reinvesting into this AI arena seriously, at least not as seriously as Meta and Microsoft. Instead, from the outside, Apple looks like they're focusing more of their efforts on financial engineering, propping up their bottom line numbers, rather than the future developments and staying competitive. However, let's also not forget that Apple has bought back more than $90 billion worth of shares in 2018, 2021, 2022, and 2023. So this buyback program in 2024 is not out of the ordinary. And throughout the entire period since 2012, they've increased their R&D expenditure every single year. So investors oftentimes forget how profitable and desirable the Apple brand equity is, enabling them to deliver so much profits to shareholders. So according to our recent calculations, we think that Apple's intrinsic value should be right around $150 to $170 per share. And even after their recent fall, it's still right around fair value. So if you're interested in how we get to our intrinsic value calculations of companies that we're interested to invest in, Piranha Profits has a powerful tool that helps you discover the right price to enter these stocks. So check out our True Value Finder to find undervalued deals in the link down below. So this is CK from Piranha Profits signing off. Till next time, keep winning.